A single policy announcement, made late at night in Washington, has triggered something the business world hasn't seen in decades. Not a tweet, not a campaign promise, a structured plan, with financing, with logistics, with a stated goal that could reshape the entire silver market. The question isn't whether this matters. The question is whether silver was quietly included. And if it was, what happens when the largest economy on Earth decides it needs a strategic buffer of the one metal that powers everything from defense systems to solar panels? The clock just started ticking, and most business leaders haven't even noticed yet. Welcome to John Analyst, where we break down the economic shifts that separate prepared leaders from surprised ones. Now, if you've been in business long enough to remember when a handshake meant something, when contracts were built on trust, not legal loopholes, then you know the value of reliable information before the crowd catches on. So here's a simple request, the kind one professional makes to another. Hit that subscribe button, not because I need the numbers, but because these briefings don't show up in your feed otherwise. And before we go further, drop a quick comment. Tell me where you're watching from. Are you in the States, Europe, Asia? Because what's coming will hit different regions differently. And knowing who's in the room helps me serve you better. All right, let's get into what just happened and why it might be the most important mineral policy shift of the decade. On a quiet evening in Washington, while most of the business world focused on quarterly earnings and market closures, a policy announcement emerged that carried implications far beyond its immediate headline. The language was measured, the tone bureaucratic, yet the underlying structure represented a fundamental shift in how the United States approaches strategic resource management. The announcement centered on the creation of a strategic mineral reserve, a concept reminiscent of the petroleum reserves established decades earlier during a different era of supply anxiety. But this was not merely an expansion of existing policy. This was the construction of an entirely new apparatus, one designed to insulate American industry from the supply chain disruptions that had paralyzed sectors during recent years. The financing structure alone revealed the seriousness of intent. Billions in seed capital paired with private sector participation suggested a model designed for scale and longevity. This was not a temporary emergency measure. This was infrastructure, the kind built to last, to operate continuously, and to serve as a backstop when global markets tighten or geopolitical tensions restrict supply flows. What made the announcement particularly significant for those monitoring commodity markets was its explicit focus on industrial continuity. The stated objective was clear: prevent American manufacturers from facing the kind of shortages that forced production lines to halt, contracts to be breached, and supply chains to fracture. The target was a 60-day emergency buffer of critical minerals, enough to bridge disruptions without triggering industrial collapse. Yet within that announcement, one name was conspicuously discussed in generalities rather than specifics: silver, the metal that sits at the intersection of monetary history, industrial necessity, and geopolitical strategy. While lithium, nickel, and rare earth elements received explicit mention in various briefings, silver remained in a curious position, acknowledged as strategic in previous policy documents, yet not highlighted in this particular rollout. This absence raised a more important question than its presence would have. Was silver being quietly included under broader categorical definitions like industrial inputs or critical manufacturing materials? Or was it being held in reserve, so to speak, for a separate announcement or procurement mechanism? The distinction matters enormously. Explicit inclusion triggers immediate market response, media coverage, and retail interest. Quiet inclusion, however, allows for accumulation before awareness spreads, before premiums widen, before supply chains react defensively. For those familiar with how large-scale procurement operates, the mechanics of building such a reserve are neither simple nor quick. A government cannot simply place an order for millions of ounces of silver the way a retail buyer places an order online. The process requires negotiations with producers, agreements with refiners, contracts with logistics providers, and the establishment of storage facilities that meet stringent specifications for purity, security, and accessibility. Each of these steps generates signals. When major logistics firms begin bidding on storage contracts, when refining facilities receive inquiries about capacity and delivery timelines, when mining companies are approached about long-term offtake agreements. These are not headline events. These are operational indicators that precede public awareness by months, sometimes years. The policy framework outlined in the announcement suggested a hybrid approach. Domestic production would be encouraged through incentives and streamlined permitting. Allied nations would be prioritized for sourcing to reduce dependence on geopolitically sensitive suppliers. And open market procurement would be employed strategically to build buffers without destabilizing pricing. But here is where the announcement intersected with market psychology in a profound way. Markets do not wait for implementation to react. Markets move on expectations, and the expectation that a new, large, non-price sensitive buyer might enter the silver market creates behavioral shifts long before the first ounce is purchased. Suppliers begin withholding inventory, anticipating better prices. Traders begin positioning ahead of perceived demand. Manufacturers begin double ordering, fearing allocation restrictions. And institutional investors begin evaluating whether a structural demand shift justifies portfolio adjustments. This cascade of behavioral changes can tighten physical availability, even when total supply remains unchanged. It is not a shortage of metal. It is a shortage of willingness to sell at current prices. And that distinction, subtle as it appears, is what transforms orderly markets into disorderly ones. The announcement, therefore, functioned less as news and more as a signal that the philosophy governing industrial supply chains had shifted from efficiency to resilience, from just-in-time delivery to just-in-case reserves, from cost optimization to security prioritization. And if silver, with its unique combination of monetary legacy and industrial indispensability, was indeed part of this strategic recalibration, then what had been announced was not merely a reserve program, but the beginning of a repricing. There exists a peculiar paradox in modern industrial civilization that few outside specialized circles fully comprehend. The most critical materials for technological advancement are often the ones least discussed in public policy debates. While politicians campaign on energy independence and technology leadership, the silent enablers of both remain obscured in technical specifications and supply chain footnotes. Silver occupies this shadow space with unusual intensity. To understand why a potential reserve program carries such weight, one must first dismantle the common perception of silver as merely a precious metal, a cousin to gold, valued primarily for jewelry and investment. This perception, while not entirely false, misses the larger reality that has emerged over the past 3 decades. Silver has become the invisible conductor of modern life, quite literally. Its electrical conductivity surpasses every other element on the periodic table. Its thermal properties remain unmatched. Its reflectivity enables technologies from solar panels to medical imaging. And its antimicrobial characteristics have found applications in healthcare settings where infection control determines life and death. But conductivity alone does not explain silver's strategic significance. Copper conducts electricity. Aluminum conducts heat. What makes silver irreplaceable in certain applications is not that it performs a function, but that it performs that function under conditions where alternatives fail. In military defense systems operating in extreme temperatures, silver connections maintain reliability when other materials degrade. In high-frequency electronics processing millions of operations per second, silver's superior conductivity reduces energy loss and heat generation beyond what substitutes can achieve. In solar panel efficiency, ratings that determine whether renewable energy projects achieve financial viability, silver content directly correlates with power output per square meter. These are not aesthetic choices. These are engineering requirements. And engineering requirements do not bend to price concerns when performance specifications must be met. Consider the mathematics of industrial silver consumption. A single smartphone contains approximately 1/4 of a gram. Insignificant. But global smartphone production exceeds 1 billion units annually. A solar panel contains roughly 20 grams. Modest. But solar installations worldwide now deploy hundreds of millions of panels per year. An electric vehicle uses between 25 and 50 grams, depending on design complexity. Growing. In military applications, from missile guidance systems to naval electronics, consume quantities that remain classified but are understood to be substantial. The aggregate demand, therefore, becomes massive, not through individual intensity, but through universal deployment. And this creates a supply vulnerability that traditional commodity analysis often overlooks. Silver production does not respond quickly to price signals. Unlike oil, where drilling can be accelerated, or agricultural commodities, where planting cycles adjust annually, silver mining operates on decade-long timelines. Most silver comes not from dedicated silver mines, but as a byproduct of copper, lead, and zinc operations. This means silver supply is largely determined by the economics of other metals, creating a structural inflexibility that leaves demand and supply persistently misaligned. Refining capacity introduces another constraint. Raw silver must be processed to industrial purity standards, typically 99.9% or higher for most applications. Refining facilities require significant capital investment, environmental permitting, and technical expertise. They cannot be constructed rapidly to meet sudden demand surges, and they tend to be geographically concentrated, often in regions where political stability cannot be guaranteed indefinitely. Then comes the question of form. Silver exists in multiple states across the supply chain, each serving different purposes. Large bars for vault storage, smaller bars for institutional trading, industrial grain for manufacturing feedstock, specialized alloys for specific applications. Each form requires different handling, different storage, different logistics. A reserve program designed to support industrial continuity cannot simply stockpile investment-grade bars. It must maintain inventory in forms that manufacturers can actually use, which means multiple product types, multiple storage locations, and complex rotation schedules to prevent degradation. This complexity explains why physical silver markets often behave differently than paper silver markets. A futures contract represents a financial claim. Physical silver represents logistics, transportation, insurance, storage, assay verification, and delivery timing. These frictions create persistent premiums and occasional dislocations where screen prices and actual transaction prices diverge significantly. When a strategic reserve enters this environment, it does not simply add demand. It restructures the entire availability equation. If the reserve prioritizes domestic sourcing, it redirects metal away from export markets, tightening international supply. If it prioritizes industrial forms, it drains specific product categories even while total silver inventory appears adequate. If it establishes long-term contracts with producers, it locks in supply that would otherwise flow to spot markets, reducing the buffer available for short-term demand spikes. And here lies the inflection point that transforms policy into market event. The question is no longer whether silver is strategic. Multiple government agencies have already classified it as such. The question is whether strategic classification now translates into strategic accumulation. Because classification is a label, accumulation is action, and action reshapes markets in ways that labels never do. What makes this moment distinct from previous discussions about silver's importance is the existence of financing mechanisms, institutional frameworks, and political consensus around the broader concept of mineral security. The infrastructure for accumulation now exists. The justification has been established. The precedent of petroleum reserves provides operational templates. The only remaining variable is execution. And execution, as any business leader knows, is where intention either becomes reality or fades into forgotten policy papers. Nations, like individuals, reveal their deepest anxieties not through their words but through their preparations. When a government begins stockpiling a commodity, it is admitting a fear it may never articulate publicly. The fear that markets, in moments of crisis, will fail to deliver what survival demands. This admission, once made by one major economy, creates a contagion of insecurity among others. The history of strategic reserves is not a history of abundance. It is a history of panic institutionalized into policy. The United States established its strategic petroleum reserve not during peacetime prosperity, but in the aftermath of the 1973 oil embargo, when gasoline lines stretched for blocks and industrial production ground to a halt. China began accumulating rare earth stockpiles not as an investment strategy, but as a response to its own near-monopoly position, recognizing that monopolies breed geopolitical resentment and eventual supply diversification efforts by dependent nations. What follows a reserve announcement, therefore, is rarely calm acceptance. What follows is competitive accumulation. When one nation signals that it views a commodity as too critical to trust to market mechanisms alone, others face an immediate strategic calculation. If the United States builds a 60-day buffer of critical minerals, does that make other nations more secure or less secure? Does it stabilize global supply, or does it remove supply from circulation, tightening availability for everyone else? The rational response, from the perspective of national security planners, is not to trust that American reserves will somehow benefit global markets. The rational response is to build competing reserves, to secure supply before others do, to avoid being the last nation dependent on spot markets when those markets fracture under stress. This is not cooperation. This is a race disguised as prudent planning. And races, by definition, reward speed over deliberation. The mechanics of such a race differ fundamentally from typical commodity bull markets. In a bull market, rising prices attract new supply. Higher copper prices incentivize new mines. Higher oil prices make previously uneconomical wells profitable. The market, given time, rebalances itself through the price mechanism. But reserve accumulation operates outside normal price sensitivity. A government building strategic inventory does not ask whether silver is cheap or expensive today. It asks whether silver will be available tomorrow. And that question has only two answers: yes with certainty or no with catastrophic consequences. There is no middle ground, no acceptable level of risk. This creates a buyer profile unlike any other in commodity markets. A buyer that does not wait for dips. A buyer that does not negotiate aggressively on price. A buyer that views every delay as a national security vulnerability. A buyer, in short, that pays whatever the market demands because the alternative, industrial paralysis, costs exponentially more. When multiple such buyers emerge simultaneously, competing for the same finite supply, traditional pricing models break down. Consider the structure of the silver market itself. Annual mine production totals approximately 1 billion ounces globally. Sounds substantial, but industrial consumption already absorbs roughly half of that. Investor demand, jewelry fabrication, and other uses claim the remainder. The market, in normal years, operates near balance with modest surpluses or deficits measured in single-digit percentage points. Now introduce government reserve programs. If the United States targets a 60-day industrial buffer, that represents approximately 100 million ounces, assuming conservative consumption estimates. If China, observing American actions, decides it also needs a buffer, add another 100 million. If the European Union, Japan, South Korea, and other advanced economies follow suit, the cumulative demand could reach 500 million ounces or more. That volume equals half of annual mine production, not spread over years, concentrated into the procurement timeline of reserve programs, which typically operate on aggressive schedules precisely because the political pressure to demonstrate progress is intense. The mathematics become uncomfortable quickly. Where does this supply originate? Mines cannot double production in months. Recycling provides some flow, but cannot scale rapidly enough to fill the gap. Above-ground inventories exist, but are already spoken for, held by manufacturers, investors, and institutions, with their own reasons for maintaining positions. The remaining source is displacement, convincing existing holders to sell. And that requires price, but not just any price movement. What emerges in reserve race conditions is a bifurcated market. Paper markets, where futures contracts and financial derivatives trade, may show one price. Physical markets, where actual metal changes hands and must be delivered, show another. The spread between these two prices, normally narrow and arbitraged away by professional traders, widens into a chasm. This divergence is not theoretical. It has precedent. During the 2011 silver spike, premiums on physical coins and bars surged to levels that made paper prices nearly irrelevant for retail buyers. Delivery delays stretched from days to months. Dealers stopped quoting prices for large orders, citing inability to source material at any predictable cost. That episode involved primarily retail investment demand. Imagine the same dynamic driven by government procurement backed by billions in committed capital. The challenge for business leaders observing this potential scenario is that the signals arrive out of sequence and often contradict each other. Screen prices may appear stable, while physical premiums quietly rise. Delivery timelines may extend while official inventory statistics show adequate supply. Refiners may report full order books, while miners report normal production. Each signal, viewed in isolation, seems manageable. Viewed together, they form a pattern that indicates market stress before that stress becomes visible in headline price movements. And here emerges the central strategic dilemma for manufacturers dependent on silver. Do they accelerate procurement now, accepting higher current costs to ensure supply continuity? Or do they wait, hoping that reserve programs proceed slowly and that markets remain orderly? The decision hinges not on what is happening today, but on what others believe will happen tomorrow. If a manufacturer believes competitors are stockpiling, it must stockpile defensively or risk production disadvantages later. This creates a self-fulfilling cycle where the expectation of shortage generates the behavior that produces shortage, even when physical supply remains technically adequate. Game theory calls this a coordination failure. Markets call it a squeeze, governments call it a strategic necessity. And silver, caught at the center of this convergence, becomes not merely a commodity, but a proxy for industrial sovereignty itself. The question is no longer whether reserve accumulation will affect prices. The question is whether it has already begun. The distance between understanding a trend and profiting from that understanding is measured not in information, but in implementation. Business history is littered with leaders who saw the future clearly, yet failed to act decisively, paralyzed by the gap between recognition and execution. What separates prepared organizations from surprised ones in moments of structural market shifts is not superior intelligence. It is superior positioning before consensus forms. The potential establishment of a strategic silver reserve, whether explicit or implicit, whether immediate or gradual, creates a decision tree that every manufacturing executive, procurement director, and financial strategist must now navigate. The branches of this tree lead to vastly different outcomes depending on which assumptions prove correct and which actions are taken in advance. Consider first the manufacturing perspective. For any company whose production depends on silver, even in modest quantities, the calculus has shifted. Previously, silver procurement was an optimization problem. Purchase at favorable prices, maintain minimal inventory to reduce capital tied up in raw materials, rely on just-in-time delivery from established suppliers. This approach worked well in stable markets with abundant supply and predictable pricing, but reserve programs, by design, destabilize this equilibrium. They introduce a buyer with different priorities, different constraints, and different time horizons. A manufacturer optimizing quarterly costs operates on 90-day cycles. A government building strategic reserves operates on decade-long national security frameworks. These timelines do not align, and when they collide, The shorter-term player loses. The immediate question facing procurement departments is whether to front-run anticipated government buying or to maintain existing strategies and hope that reserve accumulation proceeds gradually without market disruption. Front-running requires capital deployment now, accepting current prices and storage costs to secure future supply. Waiting preserves capital flexibility but exposes the organization to price spikes and allocation shortages if reserve buying proves aggressive. Neither option is risk-free. The risk lies in choosing incorrectly relative to what competitors choose. If a company stockpiles while competitors wait and reserve programs proceed slowly, the company has tied up capital unnecessarily and may face write-downs if prices decline. But if a company waits while competitors stockpile and reserve programs tighten markets, the company faces production interruptions while competitors operate normally. This is not a finance problem. This is a game theory problem embedded in operational strategy. For those evaluating silver from an investment allocation perspective, the framework requires different considerations. Physical silver, mining equities, and silver-linked financial instruments each respond differently to reserve-driven demand. Physical silver offers direct exposure but comes with storage costs, insurance requirements, and liquidity constraints. It cannot be sold instantly at transparent prices the way exchange-traded securities can. Premiums over spot prices fluctuate, sometimes dramatically, creating a hidden volatility that paper prices do not reflect. During supply tightness, these premiums can surge to double-digit percentages, meaning that spot silver might rise 10% while the actual cost to acquire physical metal rises 20 or 30%. Mining equities, by contrast, offer leveraged exposure to silver prices, but introduce operational and financial risks unrelated to silver itself. A mining company's stock price reflects not only silver prices, but also production costs, debt levels, management competence, geopolitical risks in operating jurisdictions, and environmental liabilities. During silver bull markets, mining stocks can dramatically outperform the metal itself, but during periods of cost inflation or operational challenges, they can underperform even as silver prices rise. The distinction matters enormously for portfolio construction. An investor seeking exposure to potential reserve-driven silver demand must decide whether the goal is to own the physical asset, to gain leveraged price exposure, or to participate in the industrial ecosystem that reserve programs will affect. Each choice carries different risk profiles and requires different monitoring frameworks. Beyond immediate positioning decisions, the reserve announcement, assuming it materializes into operational reality, forces a broader reassessment of supply chain philosophy. For decades, globalization enabled companies to source materials from wherever production costs were lowest. Silver could be mined in Mexico, refined in Switzerland, and delivered to factories in Asia without significant concern for geopolitical interruptions. That model, already under strain from pandemic-era disruptions and rising trade tensions, faces a fundamental challenge from reserve accumulation. If major economies begin competing for strategic mineral supplies, the assumption of frictionless global trade evaporates. Export restrictions, preferential sourcing agreements, and supply chain nationalism become not edge cases, but central features of commodity markets. Business leaders must now evaluate whether their supply chains are designed for a world that no longer exists, whether contracts signed under assumptions of abundant supply remain viable when governments become competing buyers, whether relationships with suppliers in geopolitically sensitive regions represent acceptable risks when those suppliers may face pressure to prioritize domestic or allied buyers. These are not hypothetical concerns. They are the questions that boards of directors will ask when production delays occur and revenue targets are missed. The monitoring framework for tracking this evolution requires attention to signals that do not appear in conventional financial media. Official reserve lists, when published, provide explicit confirmation, but arrive after positioning opportunities have largely passed. More useful are operational indicators, procurement tender announcements, storage facility construction permits, refining capacity expansions, mining project accelerations, and long-term offtake agreements between governments and producers. Each of these signals suggests that reserve accumulation is transitioning from policy discussion to operational implementation. And implementation is where markets reprice. Equally important are price behavior patterns during market weakness. If silver experiences a correction and that correction is bought aggressively at specific price levels, it suggests that structural buyers view those levels as attractive entry points. This creates an observable floor, not through announced policy, but through revealed behavior. Trading systems can be designed to detect such patterns, providing early warning that demand characteristics have shifted. The ultimate strategic question is not whether silver will rise or fall in the short term. Short-term price movements are noise, driven by sentiment, technical trading, and macroeconomic data points that change weekly. The strategic question is whether the relationship between industrial demand and available supply is undergoing a structural transformation that will persist for years. If reserve programs become a permanent feature of mineral markets, if other nations mirror American policy, If supply chain nationalism replaces globalization as the dominant paradigm, then silver transitions from a cyclical commodity to a strategic asset with characteristics more resembling oil than traditional precious metals. And strategic assets are priced differently, valued differently, and allocated differently than cyclical commodities. The announcement that began this analysis may prove to be a policy footnote that leads nowhere, or it may prove to be the signal that marks the end of one era and the beginning of another. Business leaders who wait for certainty before acting will have their answer. But by then, positioning opportunities will have closed. And in commodity markets, as in warfare, the advantage belongs not to those with perfect information, but to those who act decisively on imperfect information while others hesitate. The reserve question has been asked. The market will answer. The only remaining question is whether decision makers are prepared for that answer, or whether they will be explaining to stakeholders why they were not.